Hey everyone, welcome back to video number 2. This video we're going to talk about learning objective 4, which is how we account for the purchase and sale of something called treasury stock. So first let's define treasury stock and what it is. Treasury stock represents shares that a company has issued previously, but then has later reacquired, meaning we issued it before, we sold that common stock for something, and now we've decided that we would like to purchase it back and hold it for the treasury. If we're purchasing treasury stock is going to decrease both stockholders' equity in a new contra equity account called treasury stock, and it's also going to decrease assets. Makes sense, because if we've purchased these shares of stock, that means we had to pay cash for them, so cash would go down. So one more time, just to reiterate that, treasury stock, the account, is a contra equity account, meaning it's reported with stockholders' equity, but it brings it down. And purchasing that treasury stock would also reduce our asset cash. So let's see what it looks like. Here's an example on May 8th for purchasing treasury stock. It tells us that WIT Inc. purchased 2,000 of its own shares of stock in the open market for $8,000. In order to record this transaction, what we would do is we would debit this new contra equity account called treasury stock. So treasury stock common would be debited for $8,000, and then we would credit cash because we had to pay cash in order to purchase these treasury shares. So as you can see here through this journal entry, treasury stock is always accounted for using what we call the cost method. That means we always need to keep track of the cost per share for this treasury stock. The rule with treasury stock is whatever cost we put it into this treasury stock account for, that's the same cost that we have to remove it if we decide later that we want to resell those shares on the open market, something that we'll look at next. So for this treasury stock right here, we purchased 2,000 shares for a total of $8,000, meaning each share of treasury stock costs $4 per share. All right, let's look at another transaction here. It tells us on June 30th that WIT sold 100 shares of its treasury stock for $4 per share. We're going to make the assumption that the only treasury shares it had were the ones that we just purchased from the previous slide, and we know that those shares were actually purchased for $4 per share. So this transaction, this will be nice and easy. We simply debit cash for $400, and then we credit that contra equity account treasury stock to remove it from that treasury stock account for that same amount, $400. Again, this one's nice and easy because remember those shares, we had a cost of $4 per share, so we just remove them from this treasury stock account for that same value, $400 per share. Let's look at something just a little bit trickier. Let's say on July 19th, WIT sold an additional 500 shares of its treasury stock, but this time for $8 per share. So this journal entry, this one's going to be a little bit tougher. So first, we know in this transaction, if we sold those treasury shares, that we got cash. So we're going to debit cash, and the amount to debit cash for would be the $8 per share times those 500 shares, which gives us a total debit to cash for $4,000. Well, as we mentioned a couple of slides ago, the rule for treasury stock is it always has to come out of that treasury stock account for the cost that it went into that treasury stock account for. If we remember back, that was $4 per share. That tells us our credit to treasury stock common this time can only be recorded or has to be recorded for $2,000. Again, that's the 500 shares that we're reissuing times the $4 per share. Well, we can see that this entry doesn't balance out, so we need to put $2,000 somewhere else. What this $2,000 is an extra $2,000 that we've received for issuing stock. Just as we've seen all throughout Chapter 13, any amounts received for issuing stock, we always call that paid-in capital. So we're going to credit a new paid-in capital account. This paid-in capital account, though, is specifically tied to treasury stock. So we'll call it paid-in capital treasury stock. So paid-in capital treasury stock will be created here with this transaction with a credit of $2,000. Remember, that exists because we had to take out that treasury stock common at its original cost of $4 per share. All right, I know what question you're asking now. What happens if you sell it below its cost? Well, let's take a look at that. So this one says, on August 27th, that WIT sold an additional 400 shares of its treasury stock for $1.50 per share. All right, so we know the first debit, right? We know we got to debit cash. We know cash has to be debited if we sold these shares for 400 times $1.50 gives us a debit to cash for 600. Well, we also know that we have to credit treasury stock, right? And we know treasury stock, the rule for that treasury stock is we have to take it out at whatever its original cost was. And we remember that that treasury stock had an original cost of $4 per share. So 400 shares times $4 per share tells us that we're going to credit treasury stock for a total of $1,600. Well, that means we need another debit in this transaction of $1,000 to make it balance out. Our debit in this transaction, if you didn't guess it, is going to be to paid-in capital dash treasury stock, just as we saw the credit to paid-in capital treasury stock on the previous slide. This one does come with a very particular rule, though, so make sure you pay attention to this one. You can only debit paid-in capital treasury stock if that account has a balance. You cannot create a negative balance in paid-in capital treasury stock. So this time it works, right? This time I can debit paid-in capital treasury stock because this treasury stock paid-in capital account had a balance of $2,000 from the previous slide. So it has $1,000 that I can take out of there. But I cannot create a negative paid-in capital balance. Negative paid-in capital doesn't exist. So if that were the case, if by debiting this paid-in capital treasury stock account would create a debit balance in that account, here's what you'd have to do. You'd have to debit paid-in capital treasury stock for whatever the amount is that would take it down to a zero balance. And then if you still need more on the debit side to make it balance out, that remaining debit will always go to retained earnings. So one more time. If I had paid-in capital treasury stock, let's assume this time paid-in capital treasury stock had a $500 credit balance. So if it had a $500 credit balance, that means in this transaction here, I could only debit paid-in capital treasury stock for $500 to zero it out. I couldn't create a negative balance, which would mean I'd need to create another debit in this transaction for $500. That other debit would go to retained earnings. Again, that's not the case this time because there was enough of a balance in that paid-in capital treasury stock account to satisfy the whole amount of what we sold it for below that cost. But remember, we're always removing that treasury stock account at its original cost. All right, let's look at exercise 1326 real quick. All right. So exercise 1326, sorry, let me tag out of here real quick. Probably just saw the answers. That's quite all right. All right, so exercise 1326, I have it right here. This one says that we have some stock transactions for Driving School Inc. that they follow. It gives me a couple of transactions here. On March 4th, it says we issued 27,000 shares of $1 par value common stock for $10 per share. All right, so this is just a regular stock transaction here on March 4th. All right, so I got my journal here. I'm going to record on March 4th. Here we go. So March 4th, I know I'm going to debit cash if we issued that common stock. I'm going to credit common stock. And then I'm going to credit paid in capital in excess of par common. So this is how I'd record this journal entry. Let me just put some numbers into here. All right, so it looks like we issued 27,000 shares and we got $10 per share. 27,000 shares times 10 gives me a debit to cash of $270,000 here. Those 27,000 shares had a $1 par value. So my credit to common stock rule, remember, number of shares times par, tells me I'll credit common stock for 27,000 here. That means paid in capital in excess of par. It's just the difference. So 270,000. Subtract out that $27,000 that we credited common stock for. We have paid in capital in excess of par reported at $243,000. Okay, next transaction for this one happens on May 22nd, where it says that we purchased 1,300 shares of Treasury Stock common at $13 per share. All right, so May 22nd, We purchase those treasury shares. So remember, anytime we purchase treasury stock, we debit this contra equity account, treasury stock common, and then we simply credit cash. Notice I do not debit or credit common stock in this transaction. It's simply a debit to this new account called treasury stock and a credit to cash. All right, one more time for the numbers. It was 1,300 shares for $13 per share. 1,300 times 13 tells me that I'm going to record this transaction for a total of $16,900. And just to make a note for myself, in parentheses, I'm just going to put that $13 there just to make sure that I capture the cost of those treasury shares so that when I look at it later, I know what the cost was in order to pull it out at that same cost. September 22nd says that we sold 500 shares of treasury stock at $23 per share. 500 shares of treasury stock at $23 per share. Sorry, that was on September 22nd. All right, so I know I'm going to have to debit cash. All right, so cash, one more time. We sold 500 for $23. So my debit to cash, 500 times $23 per share. Tells me I got $11,500 in cash. I know I sold that treasury stock, so I have to credit this treasury stock common account. Remember, we got to remove it at that original cost of $13. That's 500 shares times $13. That gives me $6,500. That means this time I can create this paid-in capital treasury stock account. It will be credited for the difference. 11,500 minus 6,500 gives us a credit to that paid-in capital treasury stock account for $5,000. Finally, October 14th says we sold 800 shares of treasury stock. All right, October 14th. We're selling treasury stock again, so I know I have to debit cash. It said that we sold 800 shares, and we sold those 800 shares for $9 per share. So 800 times 9 tells me that I'm going to debit cash for $7,200. All right, I see that that $9 per share is less than the cost. So I'm going to skip a line here. I'm going to credit treasury stock common down here. I know that that treasury stock had a cost of $13. All right, so I sold, one more time, 800 shares at that at $13. 800 times 13, remember, because we have to remove them at their original cost of $13 per share. That means this time I need another debit to balance this entry out for $3,200. All right, I can see I created this paid-in capital treasury stock account right here with a credit balance of $5,000. That means I'm fine to debit paid-in capital treasury stock for that entire $3,200. Remember, that's only okay because there's a credit balance that already exists in that account. All right, hopefully you've enjoyed this video showing you how we work with treasury stock.